Are you watching NVIDIA drop 4% while the rest of tech rallies and wondering if you should panic? Maybe you're seeing the headlines screaming that NVIDIA is the next Enron or the next Cisco or whatever disaster comparison gets the most clicks this week. Well, before you hit that sell button, I'm going to show you why Meta's conversation with Google about buying TPU chips is not the death of NVIDIA. It's actually proof of something much bigger happening in AI infrastructure. And by the end of this video, you'll understand why the smartest investors are looking past the noise and focusing on the fundamentals. Welcome back to StockScope Live. I'm your host, Ali, and if you're new here, I break down complex market movements with data-driven analysis, not clickbait. Today, we're diving deep into the NVIDIA situation, because there's so much misinformation floating around that it's hard to separate signal from noise. Here's what happened. Meta is reportedly in talks with Google to purchase billions of dollars worth of TPU chips. That's tensor processing units. That's Google's custom AI accelerators. Deployments could start as early as 2027 with possible cloud capacity rentals next year. And what was the market's reaction, you think? NVIDIA dropped 4% immediately. But here's the hidden headline nobody's writing. Meta is not replacing NVIDIA, they're diversifying suppliers. Because when you're spending over $70 billion on AI infrastructure in a single year, putting all your chips, pun intended, with one vendor is just bad risk management. This isn't dramatic. This isn't betrayal. This is boring corporate strategy 101. In this video, I'm going to walk you through 4 key points. First, the technical reality of TPUs versus GPUs. Second, why Meta's deal is about insurance, not replacement. Third, the truth behind those Enron and Cisco comparisons. And finally, what this really means for NVIDIA investors going forward. If you find this analysis valuable, make sure you smash the like button and subscribe to the channel. This is still a new channel. We've only been around for about 4 months, and your support means a lot to us. Let's get into it. Let's start by clearing up a massive misconception. TPUs and GPUs are not interchangeable. They're fundamentally different tools designed for different jobs. Think of it this way. TPUs specialize in one type of calculation, and GPUs specialize in every type of calculation. TPUs are like that coworker who's absolutely incredible at one specific task. If you need something specific like a pivot table, they're your guy. But ask them to do literally anything else and they're basically lost. GPUs, on the other hand, are the person who can handle everything. Presentations, code, fix your printer, and still make meetings on time. They're not the best at one thing, but they can do everything pretty good. From a technical standpoint, TPUs are purpose-built for tensor operations, basically the matrix math that powers neural network calculations. They're great for large batch inference workloads. If you've ever done science projects on Google Colab, you'll probably use TPUs. They're fast, they're efficient, and for specific use cases, they're cheaper than GPUs. But here's where it gets limiting. TPUs only run on Google Cloud. That's it. If you want multi-cloud deployments, you're SOL. If you want on-premise hardware, it's not going to happen. If you want the flexibility to switch providers, you're SOL. You're locked into Google's infrastructure, Google's pricing, and Google's terms. Now, PyTorch, the dominant machine learning framework used by researchers and developers worldwide, is built around CUDA. That's NVIDIA's programming platform. The entire software stack, everything from community support, libraries, it's all NVIDIA. They learned NVIDIA's way before AI hype was even there. So switching from NVIDIA to TPUs isn't just swapping hardware. You're rewriting everything from scratch. You're retraining everyone. You're rebuilding your entire infrastructure from the ground up. The switching costs are enormous. Another expert nailed the risk perfectly. With TPUs, once you're all in and Google says, you know what, you're going to have to pay a bunch more money, you're SOL. Vendor lock-in is a real massive concern for companies spending billions on infrastructure. Number two, why is Meta doing this? And why it's not about NVIDIA failing? Because if TPUs have all these limitations, then why is Meta even considering them? Well, there's three strategic reasons. First, their advertising workload. Both Meta and Google run massive recommendation engines and ad targeting systems. These are precisely the kind of inference tasks where TPUs excel. So for a portion of Meta's workload, specifically their ad platform, TPUs are actually a great fit. This isn't about general AI training. It's about optimizing specific high-volume inference operations. And second, it's cost optimization. Google claims TPUs deliver up to 4 times better performance per dollar for certain workloads. Now, that's a big if, depending on your specific use case. But if it's true, we're talking about real money that Meta can save at their scale. Because when you're spending $70 billion a year, even small percentages improvements add up to hundreds of millions in savings. Third, supply chain diversification. Remember the chip shortage? Remember when automakers couldn't build cars because they couldn't get semiconductors? Remember when every major tech company realized that depending on one supplier for critical infrastructure is extremely risky? Well, Meta remembers, and they're doing what any smart company would, creating backup options. But here is what this deal is not. This isn't NVIDIA losing the AI race. This isn't Google dethroning the GPU king. This isn't a sign that NVIDIA technology is inferior. This is a hyperscaler with an unlimited budget buying insurance. That's it. TPUs are excellent for specific use cases, particularly inference at hyperscale within Google's ecosystem. But they're not replacing GPUs for the broader AI infrastructure buildup. They're a complement, not a substitute. And yet, NVIDIA drops 4%, which brings me to the next point. Let's talk about the timing, because something interesting has been happening. In the past few weeks, we've seen this coordinated wave of negative sentiment hit NVIDIA all at once. Michael Burry comes out saying, I'm not claiming NVIDIA's Enron, it's clearly Cisco. A viral article appears alleging NVIDIA is running a $610 billion fraud scheme with circular financing, written by a self-proclaimed independent researcher who's also, and I'm not making this up, the CEO of Pech Express in Sri Lanka. NPR runs a piece, quote, here's why concerns about an AI bubble are bigger than ever, end quote. Morgan Stanley warns of a Cisco moment within 24 months. All of this happens right as NVIDIA reports another blowout quarter, right as the stock hits all-time highs, right as the rest of tech is recovering. The timing is convenient. Now, I'm not here to spread conspiracies. I'm not saying there's some shadowy cabal courting hit pieces. But when negative narratives clusters around a stock at all-time highs, you should ask, who benefits from this narrative? The short sellers benefit, competitors benefits, media outlets benefits from clicks, and some investors genuinely believe it's overvalued and are positioning accordingly. But let's examine these comparisons objectively because they're being thrown around like facts when they're actually deeply flawed. First, the Enron comparison. The viral article claims NVIDIA is doing circular financing, investing in AI startups who then buy NVIDIA chips, artificially inflating revenue. But here's the reality. NVIDIA issued a direct rebuttal. Their strategic investment represents a small fraction of total revenue. AI startups raise capital predominantly from outside investors, venture capital firms, sovereign wealth funds, actual money from actual sources. NVIDIA isn't extending credit to customers. They're making equity investments. That's a fundamentally different risk profile. The article also claims customers are depreciating GPUs over 4 to 6 years when they should be obsolete faster. But the fact is, the A100 chips released in 2020 are still running at high utilization in data centers today. These chips have real longevity. The depreciation schedules match actual usage patterns. And because of supply constraint, starting in the pandemic times, and all these high-end chips are only made by TSM, it creates a room to extend these GPU lifelines because you can't replace them fast enough, even if you wanted to. So is NVIDIA Enron? Obviously no. Enron was accounting fraud, fabricating revenue that did not exist. NVIDIA's revenue is real cash from real customers running real workloads. This comparison is inflammatory clickbait, nothing more. Now let's look at the Cisco comparison, because Michael Burry's argument is more sophisticated and honestly more interesting. And it goes like this. Cisco sold hardware for a telecom build-out in the late 90s based on assumptions that internet traffic would double every 100 days. So what did telecom companies do? Well, they obviously borrowed billions, bought Cisco equipment, laid out fiber optic cables everywhere. But then the demand didn't materialize because less than 5% of the fiber capacity was ever operational. And Cisco, at the time, crashed 80%. So is NVIDIA facing the same fate? Are we building AI infrastructure for demand that won't materialize? Here's what's critically different. Number one, the customer quality. Cisco's customers in 2000 were Pets.com, eToys, startups burning venture capital with no path to profitability. NVIDIA's customers today are Google, Meta, Amazon, Microsoft, Oracle, the most cash-rich, profitable companies in human history. They're not borrowing to buy chips, maybe other than Oracle. They're spending operating cash flow. Number two, revenue quality. Cisco's revenue was often vendor financed. They'd lend money to customers to buy Cisco equipment. NVIDIA isn't doing that. These are actual cash payments from profitable companies with proven business models. Next is demand visibility. Cisco's demand was speculative based on eyeballs and clicks with no revenue model. AI demand is measurable. These companies are running production workloads, search ranking, recommendation engines, fraud detection, autonomous vehicles. This isn't speculation. It's deployed technology generating economic value right now. Finally, the market position. Cisco faced emerging competitors even at its peak. NVIDIA has 80+% market share and is years ahead of technologically ahead of its competitors. Now, does this mean NVIDIA can't crash? Obviously not. Anything can crash. Does it mean that valuation is automatically justified? That's a separate question. In my opinion, it's not. But is this the same situation as Cisco in the 2000s? It's absolutely not. The comparison sounds smart, but it ignores crucial fundamental differences. The last key point is the real AI infrastructure story, because that's the real question underneath all this noise. Is AI a bubble like the internet bubble? And here's where I'm going to give you a different perspective than the majority of the headlines you've seen. The internet bubble was about the future demand that never materialized. Companies were valued based on clicks and eyeballs with no path to revenue. Pets.com spent millions on Super Bowl ads and went bankrupt less than a year later. AI is already generating real economic value. How much value? That's a different question. You've been seeing AI for years without even calling it that. If you didn't know, Netflix recommendations that keep you binge watching, Google search rankings that actually find what you need, fraud detection at your bank that stop fraudulent interactions, voice assistants that sometimes work, mostly, autonomous vehicles literally driving people around San Francisco right now, drug discovery breakthroughs like solving protein folding, a 50-year-old grand challenge in biology, manufacturing optimization saving companies millions in efficiency gains. That's AI. The difference now is that generative AI Those large language models create a visible, consumer-facing story that captured public imagination. But the underlying AI infrastructure build-out serves far more than chatbots. And here's an angle that bubble callers consistently miss. This isn't just American hyperscaler capex. This is a global's arm race. China's racing to achieve AI self-sufficiency despite US chip restrictions. Although now America wants them to buy American chips, funny enough. That's a different story. Europe's investing billions to avoid AI dependency on American tech. Middle Eastern sovereign wealth funds are building massive AI infrastructure. Every major nation views AI capability as a matter of national security and economic competitiveness. If NVIDIA were actually another Enron or even another Cisco, the implications would be catastrophic. And not just for the tech stocks, but for the global economic and military competitiveness. Do you really think the US government is about to let that happen? The strategic importance of AI chips is exactly why export controls exist in the first place. And while everyone's debating whether ChatGPT will replace their job, the real AI revolution is happening in physical AI. Autonomous vehicles, warehouse robotics, human robotics, drug discovery, climate modeling, fusion energy research. These applications require more compute, not less. And they're not speculative. They're already deployed or in advanced development. So what should you do with this information? First, I always say this, don't panic sell based on headlines. Second, don't blindly hold based on what some random guy on YouTube tells you, including me. Third, understand what you're actually investing in. Because the AI infrastructure build-out is real. The demand is measurable. And whether NVIDIA captures all of that value at current price is a legitimate question. But it's separate from whether the whole thing is fraud or a bubble. Now, sometimes, narratives get manufactured, and sometimes they're right, and sometimes they're just positioning. Sometimes they're pure noise designed to move markets in someone else's favor. What I know is this. When everyone is suddenly agreeing on something in financial markets, somebody's making money off that consensus. Maybe it's the bears, maybe it's the bulls, but you should at least understand what you're buying or selling before you make that decision. All right, that's my detailed take on NVIDIA's situation. This channel is still fairly new, so please click the like button on this video and subscribe to this channel with the notifications on. Let me know in the comments, are you buying the dip? Are you holding steady? Or are you taking profits? I read all your comments and I respond to every single one. Until next time, stay safe, stay diversified, and I'll catch you in the next video.